When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions, of course, but the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing this fine weekend?
I'm doing great. Always fun to be here with you and the listeners and just talk about stuff. Nice little therapy session for me, so thank you.
Yeah, you get on your soapbox. We always enjoy that. Also want to say happy Easter to everybody. You know, we've got Easter bunnies, we've got eggs out there. I'm not sure what they have to do with the real meaning of Easter, but nevertheless, however you celebrate it, thank you so much for joining us here and including us in your Easter weekend. So, Jeff, a lot to talk about on the show today. We've got a topic that may span 2 shows. We're going to be talking about 20 costly mistakes that people make at the beginning of retirement, and I'm sure our listeners are going to really be listening to this and asking themselves, am I making those mistakes? But before we get to that, I want to talk a little bit about current events. Jerome Powell last week on Wednesday gave his address about interest rate cuts. I understand that some people are thinking that we may have 3 interest rate cuts this year, but Jerome Powell is looking at them going, well, where did you hear that?
Well, actually, I don't know. It's between Jerome Powell and the rest of the FOMC, the Federal Open Market Committee. There's 12 different sectors around the country that all participate in this quorum of economic advisors that sit there, and Jerome Powell gets to be the mouthpiece. So I remember in November the banks were getting free money from the government most of the year, and so the kind of as a QE program to the banks, and they weren't loaning the money out; they were buying stocks. So the stock market rallied first of the year up through about July. The gas kind of fell out of the market. There was really nothing left to go to push it up. People were still a little bit concerned. Inflation's still not under control yet. Started getting a little bit better, and then he comes out and says, hey, we're not going to raise interest rates anymore. That gave a little bit of fire under the market. That was back in November. We had the November to remember, and then for 3 weeks the market rallied, and then it started fizzling out. So then he gets up on his, on the podium and says, you know what? Not only are we going to freeze interest rates, even though inflation isn't really under control, we think it'll somehow magically get there by next year, and it should be down to about 2%. And in November and December, it actually looked like it was stabilizing. So there might have been a little bit of truth to the assessment. And he says, we think next year we can start lowering interest rates, maybe up to 3 times. Just said maybe up to 3 times. But John Williams in New York and some of the other Fed people said, we never talked about that in our Open Market Committee meeting. We've never even talked about rate cuts. Shoot, we're barely even grasping the idea that we're not going to have to raise interest rates anymore to get the inflation under control, because we really want it down around that magic number 2%, even though that 2% is on top of roughly 20% compounded annual inflation that we've had getting to our present day, right? Some people say 17, some people say 25. Well, if you're looking at gas and food, you're probably looking at 30. Cost of living overall has definitely gone up, and middle-class people are suffering. The rich people don't care because they have enough money. But the government doesn't care because they get all the money they want from taxpayers. So, there's a certain sector of the public that is hurting and can't buy stocks and can't take advantage of this head fake that the Fed keeps doing to make the stock market look strong. So Fed Chairman Powell comes out in December and says, hey, we think we might be able to lower interest rates. Well, right out of the gate, not only did that kind of caused the market to go up a little bit. And, without absent fundamentals, I have a hard time just jumping on the wagon because somebody says something that I think is a lie. And pardon the expression, but I'm going to use the L word. They have no intention of lowering those interest rates when inflation's still out of control, but they also don't want the market to falter, and they want to make everything look like it's hunky-dory fine. Just like they say, oh, there's going to be a soft landing, even though every time they've even said soft landing, there's been a hard landing. Anytime they've said no landing, we still get in trouble when economic circumstances and cycles are like they are right now. And, it's just kind of to ease the angst of the market, investors, just basically consumers overall. But again, back then the Fed committee was like, well, I don't think we're going to lower interest rates. But he says maybe 3, and then right out of the gate, you get people like Jamie Dimon and Chase, JP Morgan, you've got Bank of America, Citicorp. all the big banks come out right after that, hedge fund guys all over the country going like, yeah, we think there's going to be 6 or 7 rate decreases. We're going to price those in. So what happens? The market goes on a rally, and I'm thinking, okay, let's see how inflation does. So I'm okay with the rally going on, Santa Claus rally, the December thing. We had the November to remember, then we had it soften, and then they, puff the market up with these, statements that I still think are a little bit contrived and really just manipulative. However, do we go by manipulative, and just because they're manipulating, we say, oh, well, they're manipulating the market, let's just jump on board and see if this train wrecks or not? Depending on your risk tolerance, I think you have to kind of analyze that for yourself. But I don't want to do that with money somebody needs for a paycheck this weekend. But if it's long-term money, then yeah, go ahead, jump on the wagon and jump on the train. It'll probably go up for a while, but it could crash anytime too when the reality check comes. And I thought we got reality checks in like December and January when we looked back and saw the consumer price index and some of the inflation numbers actually ratcheting up. We also saw supposedly the labor numbers going up, creating net jobs. The unemployment is down. So I'm thinking, okay, these are inflationary factors. These are inflationary numbers. The actual costs are going up. And now we get, just a couple weeks ago, we get the producer price index going up 0.6 when they expected to go up 0.1 or 2, which is, even though from a year ago, because the producer prices had already gone up quite a bit, they've been pretty flat all year. So they're looking backwards saying, oh, it's only up 1.6. But wait a minute, if it's up 0.6% in 1 month and you times that by 12 going forward, in other words, the trend goes from 1 or 2 upticks per month or tenths of a point per month, which equates to about 1.5 to 2% inflation long term, which is why I think the Fed got some people believing that maybe inflation is getting under control, because if the producers don't have to pay a lot more for goods and services, then they can pass those savings on, or they don't have to raise the prices and stuff to the consumer as much. So we get this 0.6%, which may even be revised upward. It seems that that's usually the trend that happens. They get the real number a month later and nobody hears about it because they're already getting next month's fake numbers or the estimated numbers. And a lot of times I think they're contrived. But just to have the point that they would say 0.6% increase when they could have probably lied and said half that much and got maybe less of a knee-jerk reaction like, oh my gosh, maybe inflation's back. But that only lasted a couple of days. 0.6 times 12 is 7.2%, right? If you just time it in simple interest basis, if you compound it, it's closer to 8. So the producer price index on a monthly uptick basis says that, their prices are growing at an 8% annualized rate if you times that by 12. Now, I don't know if it will. We're going to have to see a trend here, but 4 out of the last 5 months, we've seen upticks in inflationary numbers. We haven't seen, supposedly they're creating jobs, but there's a lot of economic factors that don't jive with all this stuff. They keep creating all these jobs, and it's largely government jobs that don't pay a whole lot. And I hate to sound cynical here, but I think a government job is somebody who gets a gift card and a green card when they illegally cross the border, maybe. And that's now a job created. But what about the 50,000 plus? We talked about this very briefly last week. The 50,000 plus highly paid high-tech jobs that have been gone just year to date, which I think is the fastest or second fastest rate of layoffs that we've seen in that market, I think, ever. So Why are these companies laying off people if the market is so strong, if the economy is so strong? Why did the metaverse all of a sudden go into hibernation so that Meta, Facebook, could concentrate just on basically not spending money, firing all their people or laying all their people off, and just doing ads? And so all of a sudden they show record profits. Somehow the stock starts shooting to the moon. Well, they're not putting anything into infrastructure. They're not keeping their employees on that can build stuff and build stuff for the future. And then you get Mark Zuckerberg selling, $500 million in his stock 3 or 4 times every time he, looks over his shoulder and sees how high his stock is and sees the fact that their company's getting weaker and weaker because he's laying off people and not even doing the R&D that he, was into, which was building a whole foundation of why they changed the name from Facebook to Metaverse in the first place. So they've abandoned that. We've got Apple abandoning the electric car. We've got, Tesla running scared, lowering prices on everything because they've got a Chinese competitor. You've got, Google laying off people. You've got just about every company out there is scaling back in some form, but they're saying, but we're doing AI now, or but we're going to buy some chips from NVIDIA and make a new thing. And NVIDIA stock goes up and their stock goes up because they're going to buy some new thing with an NVIDIA chip. It sounds just like a bunch of contrived hype to me. I've seen this before. After 35 years of being in this business, I've seen the dot bombs, which was just a bunch of BS that made Wall Street go crazy, and everybody on Wall Street got rich and everybody in the public got poor for a while, and in some cases took 10 or more years to get their tech stocks back on track. And so, people that were ready for retirement or getting close to retirement or already retired in that market suffered greatly and had to change their plans. I don't want that to happen again, and so I'm very cautious about what I'm hearing the Fed say, especially on this last round, I'm getting back to your question now.
Right.
So I want to kind of lay the foundation for the history of where we're at now. So now the banks are all going, well, I don't know. Maybe we're not going to have a recession and maybe we're not going to need any rate cuts. But it's okay because the Fed's given us trillions of dollars and we're okay. We're investing in our own stock. We're doing stock buybacks. Oh, but Jamie Dimon's selling, hundreds of millions of dollars worth of stock because why? Oh, because his stock's going to keep going up because it's a great deal to get out. Well, if it's a great deal to get out, it means, he doesn't think he's going to make more than 5 or 6% on his money, or he'd have borrowed it from his own bank and used the stock as collateral, right? And that's the same with Bezos selling $8 billion and so forth. So now we get Chairman Powell gets up, says, well, we might have to stay solid for longer. We think this is just a seasonal uptick in the producer price index. Seasonal, like what? All of a sudden around Christmas time, stuff costs more? No, I think stuff would cost more in preparation for the Christmas holiday sales rush from the standpoint of producing items, right? It shouldn't happen afterwards. That's when everybody isn't buying anything. So that's when you have, excess inventory you want to sell off right before the end of the year. You sell everything out as a sale because you want to, raise cash for the final month so it looks good on your balance sheets and all that stuff. I think the last couple of months should be, I would have expected a downtick just from a logical perspective on, producer prices, yet they went up in January significantly. And we've got more numbers, always coming out that are going to show us that we really are in inflationary times. So Fed says, well, we might have to hold it for longer. We might not have rate cuts as early as June, but we'll see. And then funny, the rest of the Fed goes, oh, no, we still expect 2 to 3 rate decreases. They were the ones that 2-3 months ago were saying, we never talked about that. We don't know if there's going to be any. We've got to get inflation under control, and it's not under control yet. And since then, we've had 2 more months of surprisingly high inflationary numbers. So inflation is not getting in check. We should have a rate increase to get it in check, not a rate decrease. But what happens if they increase rates and all of a sudden go back on their word that they're going to lower interest rates, and all of a sudden the market freaks out, there's a sell-off, and then, the party in power who's kind of manipulating the Fed backdoor, because they always do, the White House, is, not going to have, is going to probably lose some of their percentage poll points in favorability towards the, getting close to this new election. So, we always see the market kind of stabilize right before an election. The thing is generally we see that happen when the economic situation isn't as dire looking it is right now. And I hate to be a pessimist, but the economic indicators, which are the leading economic indicators, LEI, has gone down 21 months in a row. I mean, the indicators that say whether we're heading towards a recession or not are actually getting worse every month. So 21 months in a row, leading economic indicators are worsening, not getting better. We have earnings last year flat. We actually had the last quarter of last year, earnings in the S&P 500 overall were down. We only had a couple of companies that came in with good profits. NVIDIA, because they're selling chips that they probably won't end up even being able to build. And by the time they can, who knows, those companies may have canceled and gone somewhere else. So you got to kind of take that a little suspect. I mean, everybody's trying to scramble to get the capacity to build faster chips. You got AMD competing, got Intel competing. You've got all these companies that are trying to get a piece of the AI business, and they're abandoning their core businesses in the meantime and not making earnings. How do you survive long term on that? It just makes me skeptical and a little worried, and it makes me happy that there's 5% money with no risk out there, and 9 and 10% money in private equity investments that we have that have very little risk, and indexed annuities that from a year ago are up more than 10% without risk. So the nice part is you don't have to be too upset about not getting this 9% year-to-date rate of return or the 10 or 20 that could be gone in a flash last year if you can just plug away and be the tortoise in the race and just make money as we go. So we don't have to worry about all this stuff if you've got the right plan, if you've got the right amount of safety in place, if you're willing to risk the amount you can afford to lose or wait on and limit it at that, then go into the market, but do it skeptically and do it judiciously. I don't think if it's money you need to hold on to and you need to pay your bills in the next couple of years would be a smart place to put in the market when it's as high as it is because of, what you said. The interest rates, if they come down, I think it's only going to be to support the market so it doesn't crash, but I still think there's corrections ahead. I think they can escape a crash, but not a correction. And the thing is when they do that by lowering interest rates, all that does is create inflationary pressure again. So they're in a catch-22. I don't know what the Fed's going to do to get us out of it. I do think the election will probably make the market a little more stable than unstable just because of where we're at in the year. But I don't know. I just wish there would be, I wish I had a higher level of confidence that what I heard from the Fed was actually a plan and they stuck to it instead of just let's see what happens type thing. Because that's all we can do is like, well, they're saying this, but let's see what really happens. Well, I guess we'll know in a few months.
Well, I kind of feel like once the election is over with that we may see some movement here. But yeah, I'm with you on this. I mean, they say there could be 25 basis points cuts 3 times this year. I don't think it's going to happen. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson, and we're talking about current events. And in just a moment, we're going to be talking about 20 costly mistakes that people make at the beginning of retirement. Hopefully, you're not making these mistakes. If you'd like to sit down and talk with Jeff about your individual situation, maybe hash it out with him and to put you on a path towards a confident retirement, we are offering a no-cost, no obligation, and no judgment Premier Retirement Roadmap Review. To get yours, very simple. All you've got to do is call 520-780-9059. That's 520-780-9059. You can do it this weekend. Leave your name, your telephone number. Shelley will give you a call back during the week and set you up with an appointment with Jeff to sit down and ask your particular questions that relate to you and your journey towards a prosperous retirement. Once again, it's not going to cost you anything, but it could be the best phone call you'll make all year. Once again, that telephone number, 520-780-9059 for your complimentary Premier Retirement Roadmap. You can also find out more about the firm and request your roadmap online at premret.com, premret.com. All right, Jeff, let's jump off on this 20 costly mistakes people make at the beginning of retirement. The first one has to do with staying in your own home. And not everybody makes this mistake, but some people think that once I retire, I've got to relocate or I've got to downsize my home. Why is that a mistake, do you think?
Well, I don't know. It's a mistake if you find out you don't like it there. You know, some people might think, oh, you know, I just love Arizona in the summertime. I'm in Minnesota. I hate the cold winters, and I'm going to go down there and relocate. And then you find out the summers are so blistering hot. You wish you'd have kept the home back in Minnesota to go to. And then you think, oh, that's what they mean by snowbirds. They want to get out of here, and they want to come down there and get out of the snow, but they also want to be desert rats in the summertime and get the heck out of here. So, I mean, sometimes relocating is find out you don't like it. I think, you know, you need to test the waters probably year round if you're looking at doing that. You know, I've had some clients that have been here for a few years and just, you know, say, you know what, we just miss home. We're going back. Kids are there or whatever. You know, relocating, I think also, you know, if you look at relocating, some people think, oh, we've got all this equity in the house, let's downsize and, you know, get a smaller place and take some of the equity and reinvest it. I think that's probably a smart plan if you need the money or if it helps ease the burdens from the standpoint of, you know, just financial independence. But, you know, if you're changing locations, you know, some people have made the decision to maybe keep their home, Airbnb it, and then actually Airbnb a couple of places or just go to rent a place seasonally in a couple of spots just to see how you like it.
Sure.
And then test the waters out while you're not necessarily getting rid of the house. And yeah, so you have some taxes, but hopefully you can get some renters in there that could take care of it. Or you just say, you know what, I don't want to make a decision I regret. The house is paid off or I don't have a mortgage anyway. Let's just, you know, have somebody watch the house for us while we're gone for a few months and let's test the waters. Of course, it depends on where you're at financially if you can do that. But one thing about downsizing your home, and I will say that just because I started the grandkid thing early,
right?
And I've seen this happen that, you know, what if you just go to a little place, hey, we don't need all the space anymore. We're just going down to Texas or Arizona, the Sun Belt. We want to retire down there. We're just going to get a little 2 or 3 bedroom house. We don't need big space. And then you end up having 3 or 4 kids that end up getting married and having 3 or 4 kids of their own. And then you've got Christmas time. There's 25 people at your house and you have to either rent them a hotel or whatever. Sometimes keeping the big house where everybody could have fit might have been the best decision you ever made.
Yeah.
And that's actually what we've done is, you know, we kept a big house because, man, there's room for everybody when they come over on Sundays. Yeah. During the week, not much to do with the extra thousands of square feet of living space we're not using. But I'll tell you what, it sure comes in handy when, you know, kids are upstairs making noise and I can go down to my dungeon and watch football or whatever. And into my man cave or that we have a family room that can sit, you know, 16 or 18 people where we're playing, you know, big games with kids and adults alike. And, you know, I'm just saying that's my situation. But, you know, we've talked about that. It's like, why would we downsize? Shoot, you know, our kids are just going to get bigger and their grandkids are going to get bigger. And, you know, let's just find another way to make ends meet and, you know, not downsize. The other thing you think about is when you relocate or downsize, you still have to pay a commission to somebody to sell your house. You pay a new one getting in. Typically, you end up in just about as worst financial situation because that new, smaller house probably costs as much as the old, bigger house you're selling. I just think it's maybe not a common big mistake, but it's something that people, I think, don't think through all the time. thoroughly enough, and then maybe half the time they feel like, oh man, maybe I wished I shouldn't have done it. So there's just a couple ideas to think about, when you change settings. But if you love your home, what's wrong with just aging in place until you decide it just isn't right for you?
Right, just stay there in your home. No reason to relocate. And if you are thinking, well, I don't want to cool or I don't want to heat, 4,500 square feet, I don't want to clean all of this. Here's an idea. Why not just close off some doors? I mean, live in the 1,500 square feet that you want to live in until the kids come over, then you can open those up. But yeah, if you love your home, there's really no reason why you have to move. But people, for some reason, think that they've got to move when they get into retirement. We're talking about some costly mistakes people make at the beginning of retirement with Jeff Fogan. Jeff, next one is planning to work in your retirement years. Now, why would that be a mistake, do you think?
Well, I think if you plan to work and you're relying on that income, I think that might be a mistake. I think if you get to full retirement age or you get to, the 65 when you go on Medicare, let's say, and then you work because you want to, hopefully you get to that point where you're working because you want to, not because you have to. Sometimes you plan like, well, I'm going to work till I'm 72. And so as long as I save my $30,000 a year and I don't have to spend any of my retirement money, I can wait till I'm 70 to take Social Security, I'll have that lifestyle met and I'll be just fine. Well, what if your company has a policy that at 65 they no longer keep people once they're on Medicare, or maybe because you're at the highest level of your pay scale and there's a little recession or a blip in the company's business plan that you end up getting furloughed or laid off? How are you going to get a new job at 68? Oh yeah. But my situation's so secure and I love my work. Okay, well, what if you have a little heart murmur, a heart attack, and you have a brush with reality that life is not eternal and that you might want a few years of retirement before that? So you never know what could happen. I think you still want to plan to retire as efficiently as you can in a financially independent basis at a certain age that makes sense. But just because you plan to work in your retirement years, I think you should consider that the gravy money, not the money that you need to pay bills, because that might not be there feasibly, as feasible as you think, either because the employer doesn't need you, can't have you, policies change, economics change, or you just have some sort of a health issue that doesn't allow you to work into your 70s or 80s. I have clients that are doing that. I mean, that are still, consulting back at Raytheon or doing something that they really love to do. And as long as it works, it works. And hey, it's great that they don't have to spend as much of their retirement money as they had planned earlier. It actually gives them a chance to where maybe they can still stay engaged in the market a little bit longer because they, have a paycheck and they don't have to worry about a big market fluctuation making a difference in their retirement plan. It's because they're earning that money to support themselves if some of their assets did disappear. But I think that's a mistake that people maybe bet too heavy on. I've seen it happen. Again, it's about a 50-50 chance that's going to work out the way you want it, and if it doesn't, it could have devastating financial results. So make sure you have your plan in place even before you decide to work into those retirement years, just to make sure that if it doesn't pan out, you're still okay.
I think it's vital to have that backup plan, and like you said, you may want to work into retirement. You may not be able to do that. So at least plan to have a dignity floor. And what I mean by that is enough money to pay the bills, have a roof over your head, and food on the table, but do not count on working into retirement, even if you want to. We're talking with Jeff Fogan of Premier Retirement Planning and Wealth Management. We're talking about some of the mistakes people often make just before retirement. And we're going to answer some listener questions in just a moment. And then later on, we'll continue this conversation. But in the meantime, listening to the program today and you'd like to get in and sit down with Jeff and talk about your individual journey towards retirement and sort of run some ideas by Jeff to make sure that you're not making mistakes. Maybe you're worried that you're going to run out of money. Maybe you don't know how you're going to pay for health care. Well, Jeff may have some answers for you. It's a no-cost, no obligation. We call it Jeff's Premier Retirement Roadmap. It's a 5-point retirement review that includes an income plan, investments to support the income plan, a tax plan, health care plan, and an estate plan. And we're offering it to our loyal listeners at no cost and no obligation whatsoever. To get yours, call 520-780-9059, 520-780-9059. While you're thinking about it, make that call today. Leave your name, your telephone number. Shelley will be happy to call you back during the week and set up an appointment that is convenient for you. Why wouldn't you want to make this call? It's 520-780-9059. It's not going to cost you anything. There is no obligation whatsoever, sort of a community service that Jeff does for our listeners. Again, make that call this weekend, 520-780-9059. You could also request your plan online at premrat.com, PREMRET.com. Happy Easter, everybody. Have a great weekend. We're going to take a quick break. When we come back, we've got listener questions, and then we'll continue with our mistakes that people often make going into retirement. All that and more when our show continues here on 790 KST, Tucson's most stimulating talk.
Hi, this is Jeff Vogan, founder and CEO of Premier Retirement Planning and Wealth Management. We're in the financial planning business so you can be in the let's have fun and not worry about your retirement business. It makes no difference to us whether you want to hang out with the grandkids, go back to school, start a new career or hobby, or spend your retirement partying in the Caribbean. These are your choices. Our mission is to help you protect your life's work and turn it into a predictable income plan to finance the things that make you happy. Premier's investment philosophy is simple. Protect and manage your savings. Create strategies that seek not only to provide an income stream you can count on, but to grow your principal to keep up with your lifestyle. Retirement the way you want it. Finding the right partner that really understands you and your goals could truly shape your life for the next 30 years or more. So call us at Premier Retirement Planning and Wealth Management for a complimentary, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or visit us online at premret.com. That's PREMRET.com.
Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Jeff, we've had a great conversation this morning in our program. We've talked about current events and Jerome Powell lowering interest rates. We've talked about the market and the economy, what consumer sentiment is, and we've also begun to talk about some retirement mistakes that people make just before getting into retirement. If our listeners have missed any part of the show today, they want to hear it all over again, don't worry, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, in this segment, we always have listener questions, 3 lined up for us again today. We'll start off with Paul listening to us right here in Tucson. And Paul writes, my wife and I have 4 grown daughters. We're revisiting our family trust for the first time in many years as we're getting older and have gradually built an estate worth a couple of $1 million. We want to make sure that in case our daughters get divorced, our hard-earned savings go to them and not to their ex-husbands. We consulted with 2 estate planning attorneys and they get 2 different answers. The first said that there's nothing we can do legally to enforce that the inheritance stay separate, and the most we could do is put something in wording along the lines of, it is our wish that the money stays separate. The second attorney said that we can make our children sign a prenup as a condition of their inheritance. Furthermore, we have one daughter who's already been married for 5 years and has 3 children, another daughter who just got engaged, and 2 other children who are single. Our married daughter does not have a prenup agreement. How do we protect our gift to her? A retroactive prenup? How should we proceed? What's your opinion?
Well, it is interesting. Different attorneys have different opinions just based on their experience with law and legal matters. I think, I'm a certified estate planner, but I'm not a lawyer, so I'm not going to give legal advice here. But I do understand the processes and what you can and can't do to a large extent. However, in a community property state, any commingled asset is community property. It would be basically just as much the spouse's as yours if you commingle. I do believe the laws do support here. They have so far to clients that are using this is what we call just taking that property, taking that inheritance as sole and separate. If you never commingle it, you never put your spouse's name on the account, you never use it for anything that, is commingled, like you don't pay your mortgage payment out of it because it's a jointly owned house, that would be commingling. So there's basically certain things that you can do to kind of gray or muddy the waters or get into gray areas with that. So you need to keep it totally sole and separate. Always keep that asset in your own name. Now, will your daughter do that? Will your daughter not just say, oh, well, we love each other and we're so married and we love each other so much that, we'll continue to just share it. And I know he would never leave me or take my money. So, if they do that, there's nothing that says once you're dead, your daughter can't give that money that she receives to whoever she wants to. There's nothing that says it can't go there unless, you put some sort of a deal in the trust that says money shall stay in trust until my daughters no longer have a husband. Well, that's kind of restrictive too. Like, well, you got to wait till he dies, till they get divorced before they get it. Or you could just say, hey, this is going to be a 20-year payout so that, they can't spend it all at one time anyway, that my daughter will get the money and she could use it for whoever she wants to. And if that annuity or whatever you have has a death benefit or a beneficiary other than than a spouse, it would just have your daughter's name on there. And then if your daughter inherits it, she would put the children as contingent beneficiaries, her kids, if any, as contingent beneficiaries. If she doesn't end up having kids, then maybe the other sisters or other family members would be the contingent beneficiaries. Now, in a community property state, if they're here in Arizona or another state like it, the husband would have to sign a disclaimer that they are no longer in line to mandate that they are the primary beneficiary on something that's inherited by the spouse. So, something along the lines of a prenup, or even something that says, even after marriage, I think my opinion would be, again, it's not legal opinion, but my opinion would be you could do a letter stating that I disclaim any right, title, interest, or future interest to any money that's inherited from the parent estate to my wife and children. And if with that note, along with an application, even without the disclaimer on the application for a new account or something like that, would very likely suffice if you had it notarized and it was witnessed or whatever. You could probably cover yourself that way. I think two people who love each other, they go into the idea thinking that's all going to be fine. And I know sometimes that could be an uncomfortable step to force upon a child that's in love and can't think of anything going wrong with their marriage. But, I think the language in the trust obviously, states the purpose. And when you do a trust, because it's not enforced by really anybody other than the trustee, which is probably going to be your kids themselves or somebody that you trust, it is based on trust. It is not based on somebody enforcing the law through court or through garnishment of wages or through managing your bank account or through, managing your assets per se. It's really just a trust between you and the trustee that takes over for you as trustee as long as you're alive. So you're the trustee as long as you're alive of your trust. You get to make all the decisions, but once you're gone, who's the next trustee? They get to make the decisions based on what you put in your trust as your wishes, and you just trust them to do so. So again, there is certain things that you can trust will happen, but there's no guarantee once you're dead that anything will happen. So I think the reality is both attorneys were right. One probably just leans in favor of the other because of their own personal experiences with trust and, family matters. But I think there's a combination of those two things that you probably should do to cover all the bases you can. But again, once you're dead, the last people that leave the earth usually win some way. I hope it's your daughters, and I hope it's, not the sons-in-law, especially if they're on bad terms. But if they're still on good terms and your daughter wants to inherit that money, whether it be in lump sum or over time, and use it for joint purposes, I don't know how you could necessarily keep that from happening, but you could suggest that they do some sort of a disclaimer letter that, hey, I'm no longer taking claim that this is, I accept that anything you receive as an inheritance from your parents' estate is your sole and separate property, and will continue to honor it or respect it as such. So maybe that's the way to do it, but your daughter's going to have to still do her part too to make sure it doesn't get commingled.
Paul, we certainly appreciate you listening to us there in Tucson. Good luck to you. And again, if you want to talk to Jeff, 520-780-9059 to set up a personal consultation. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question is Gary in Green Valley. And Gary says, I'm 35, one of our younger listeners, single and getting an annual bonus. I'm not sure the best use for it. After I pay off my credit card balances, I'll have roughly $10,000 left. Here's a rundown of my finances. My emergency fund's about half funded in a high-yield online savings account, providing me with 3 months of expenses. I've got about $60,000 in student loans. I could pay a few of the smaller ones off as they have the lowest interest. And I have a personal brokerage account that I haven't really done much with, and it has about $500 in it. I grew up pretty poor, so I'm not used to getting large amounts of money at one time. Whatever I do, I would like to put the money to good use. Any advice is greatly appreciated.
Well, I'm a strong proponent of savings early, and the earlier you start, the better. Sounds like, I don't know if you have a 401k, I don't know what your income level is, but I'm assuming if you're 35, you're probably kind of a moderate income level, maybe not exceeding the amount where you can't contribute to a Roth IRA. I think some of it ought to go into a Roth IRA because it's tax-free future assets. But I also think you should pay down some of those student loans. I'm glad you're paying off your credit cards. Those are typically the highest interest. But you mentioned, at least the way I heard the question was, you want to pay a few of the smaller loans off because they have the lowest interest. I would pay down the ones that have the highest interest because the highest interest is the ones you want to get rid of. That's why you want to pay off your credit cards first and then the high interest loans. If you have a small loan that only has a 2 or 3 interest payment, shoot, you're probably making more than that on your high yield savings account in the bank that you've got your emergency fund in. I think at your age, you're single, and maybe 3 months of emergency expenses may or may not be a good amount. Maybe you ought to add a little bit to that too. Maybe out of the $10,000, if you're going to get $10,000 a year in bonuses, and that's kind of the net of the bonuses, maybe you put an extra $3,000 to $5,000 of paying down loans. You put a few thousand into a Roth, and add it over the next few months to try to get that 6 months. The rule of thumb is kind of 6 months of expenses in your bank account in case something bad happens. So I think you probably do have a good start on that with the 10. I think if you keep looking at I'm glad you're prioritizing savings, but if you keep on doing what you're doing, in 30 years, when you're 65-ish, when most people are retiring nowadays, you should be pretty well set without debt and with a bunch of savings in the bank and hopefully a bunch of tax-free savings, because I'm guessing you're not at a high enough tax bracket where putting into a Roth is a bad idea, because you don't really probably need a tax deduction now as much as you might be when you're rich and retired and are in a higher tax bracket later. You'll really be glad you had that tax-free Roth money.
So, Jeff, I think Gary's got time on his side, being only 35 years of age, but still, it's a good idea to pay off debt if you can. So, again, I think what I'm hearing from you, Jeff, is pay off some of that debt, but invest the rest of that. Gary, we appreciate you listening to us, and, of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question is Brian listening to us in Oro Valley, and Brian writes, I'm 65 and I've been looking at financial advisors. When I filled out a retirement plan questionnaire with one of them, the advisor suggested that I use a value for expenses that is less than my current expenses. But when I think about it, I don't see how my retirement expenses would be much less than my current expenses, except for paying off my house, which won't happen for several more years. I don't see how my costs would be lower. With all my free time, I want to do more things like join a gym, go on vacation, see more shows, see more concerts, go to baseball games. How do people in retirement spend less money in retirement than before retirement?
Well, unfortunately, some people are forced to because they don't have enough savings. They haven't made enough money. They didn't put away in the 401k. They didn't take advantage of the employer match programs, and they're in a pickle, and they really can't do much else. It's funny. I go on websites and I see the retirement plan, the typical brokerage firm, the typical Wall Street firm. Pick one: Fidelity, Vanguard, all the big ones. You can get a kind of a general idea that says, this is your retirement plan. If you're making $200,000 now, you should be able to live on 70% of what you're living on now. In other words, your income in retirement should be 70% of that 200, so 140. Well, I will venture to say, I will say just from experience, there's a lot of people that are making $200,000 and living on 60 just comfortably. And if their income went down to $100,000 a year spendable, which means that they're no longer saving, but they're spending some of that money. But when they were making $200,000, they were able to pay their portions of Social Security. They were able to pay their health benefits, Medicare insurance. They were able to put away in the 401k. There was a lot of money out of that $200,000 that didn't just go to taxes, but also went to the withholdings and the savings account for the future. So what were they really living on at that point? I think sometimes those factors say, well, because you were living on $200,000, because you're putting away so much of your money, you're probably really only living on 70%. You should be able to keep living the same lifestyle on 70%. But you're right. You have a lot more time to spend money now. When you were going to work, you didn't spend money at work. You were making money at work. You weren't going out to eat lunch every day. Maybe you're brown bagging it or eating out of the cafeteria at work, whatever. Maybe now you want to go to nice places. Maybe you want to actually travel more. Maybe you don't need to buy a car as often because you're not commuting every day 30 miles back and forth to work every day. But maybe you're flying on planes to Jamaica and Philippines and Japan and Europe and trying all the kinds of travel and fun stuff that isn't cheap. So again, I think your question is very, very correct. But how we build a retirement plan is, okay, if you live a nice full life, how can we structure this income plan? What is the magic number of income that we can count on or predict based on reasonable assumptions, rates of return, taking out a lot of volatility through using principal protection products like the indexed annuities with income riders on them that give you guaranteed income regardless of the performance. When you have principal protection and the market doesn't go down, if you made 5 or 6% on something that never went down, your money will last longer than if you make 10% if the market's going up and down all over the place and being volatile. And you can look at average rates of return, and it doesn't matter if you have to add a factor of volatility that's excessive. You look at the lost decade of the years 2000 to 2010. They call it the lost decade because there was 2 crashes on the S&P 500 of about 50%, and it made that decade basically come out zero. Well, if you're spending money for 10 years during that decade, and the market's down, guess what? You might think, well, gee, okay, the money came back to half and I spent X, so I should have at least half my money. Guess what? It doesn't work that way. Every time the market was down below the equilibrium start point, you were spending maybe double the amount of investment capital per dollar that you would have spent had the market not gone down. So you probably end up, if the market goes down, let's say you have $1 million, but you spend $500,000 over the next 10 years. You're not going to have $500,000 just because the market's even. However, what if you had an indexed annuity that made half the upside of the market but none of the downside? Guess what? You would practically have almost your million. You'd be probably in the $800,000 or $900,000 range had that been the case, whereas you'd be probably at the $200,000 or $300,000 range if you go through a decade in the roller coaster ride of the stock market, even though over time the stock market averages 10. So again, you have to be careful as when you build this income plan, you have to use the right products and strategies, and you actually kind of reverse engineer your spending habits based on, okay, I have X amount saved. Maybe it's $1 million, maybe it's $2 million, maybe it's only a few $100,000, but you've got a nice pension. How do you maximize the use of that extra savings dollars to increase what Social Security, pensions, and other guaranteed income sources will pay you? If your guaranteed income sources are only going to be $40,000 and you're used to making $160,000, but you want to spend $170,000, well, I hope you have $3 or $4 million in savings, because it might take that in a well-planned retirement roadmap in order to make that work out. If, however, you got a couple million, you can live on $100,000, but you've got $80,000 between you and a spouse and Social Security and pensions, and you only need $20,000 to make up. I mean, you only need a few $100,000. You can probably get by with that. And then if you want some extra, travel and fun money, well, hopefully you have some more savings that we can earmark for those fun things. But again, if the market's volatile or if your investments are volatile, you're going to have to dial back on the amount that you think you can spend, just because volatility will eat that up if you're planning on spending it on a regular basis. So lock up in principal protected accounts and things that guarantee income or predict income on those things that you need for income, and maybe give yourself a little buffer for the fun things. And then, if you want to risk and shoot for the moon on how much fun you can have in retirement for those extra trips and things that are extra costs, and you don't want to risk that money, then maybe that's up to you. But it just kind of depends on how secure and predictable do you want your future to be. And if it comes out that a reasonable rate of income spend is X, then you might just have to say, you know what, I can live on this if I don't risk or lose a bunch of my money. That's better than living on this, which is less, if I keep a lot of it at risk and the market goes gyrating crazy like it did in the last decade, or if we have another couple of crashes in the next few decades. By the way, your retirement's going to be a few decades. You tell me there's not going to be a crash in the next few decades? Well, the Fed might tell you, government might tell you, somebody in the White House that wants to win a re-election might tell you. But the reality is the market always corrects, and there are always big corrections, when the market gets overextended like it is right now. So just expect that to happen. You've got a plan for that. And, when you build your income plan, take all that into consideration, line it up, figure out how much you have to spend, and then maybe you budget accordingly. So we kind of like to reverse engineer that plan. I can't find extra money for you just because you want to spend more. My opinion is, though, if you're 65 and you do a plan now and find out that working an extra couple of years might help you get to a more comfortable level so that you can travel and do those fun things and spend more than you're spending now, then it might be worth considering that. Or you come in and find out a plan that if you put your money in a safe place, you can still do all those fun things, and you should have retired a couple of years ago, then shoot, turn in your walk-in papers now and say, I'm out. I'm going to go start enjoying my time, and I'm going to spend more money than I used to. So again, everybody's situation is different. That's why we do a plan. That's why we assess where you're at. We play around with the numbers. We build a plan that gives you realistic income for the future. And then we see if it doesn't fit your retirement needs. And sometimes you need to kind of readjust that perfect ideal retirement life and dial it back if there isn't enough money there. More often than not, however, if we structure it correctly, save you some taxes, and build out a plan that creates guaranteed income, you'll find, like most of our clients do, that you can spend more than you thought in retirement and maybe do a few more fun things without worrying about them like you might otherwise would have if everything was sitting out there at risk in the same places that built your retirement plan. Because what builds your retirement plan is not generally the same strategies that secure it for the future.
Brian, thanks for that question. Thanks for listening to us in Oro Valley. Of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you have a question you'd like us to answer on the air, you can get it to us by going to our website, premret.com, premret.com. There's a contact page there. Send us your question. If we use it on the air, we'll send you out Jeff's book, Retirement: The Road Ahead. You're listening to Premier Retirement with Jeff Vogan. And a reminder, we're on 4 times a week here, Saturdays at 7 a.m. and 9 a.m. and 1 p.m. and Sundays at 11 a.m. If you've missed our show at any of those times, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Jeff, let's continue our conversation that we started on today's program about costly mistakes that people make before retirement. Next one here is going to be taking Social Security benefits too early. Why is that a mistake?
If you take it at 62 because you think you're going to retire, that's all hunky-dory fine. You're going to take less than you would get if you waited to full retirement age or later. And then if you decide to go back to work, you're limited to about $20,000 a year in earned income. And then they're going to start withholding a dollar for every $2 you earn over and above the threshold of that limit. So, if you end up making $50,000 and you're only making $15,000 of Social Security, you could end up basically having them withhold your Social Security. The thing is they give that back to you over time, but they don't actually increase your future payments as much as they would have increased had you just waited in the first place. So if you're going to take Social Security early, be really sure that you're going to only work a part-time job. They don't just give you a lump sum, say, oh, we withheld it last year, now you're not working, here's the chunk that we held. They actually amortize it with increased payments, but they do it based on your life expectancy. You may not live long enough to even collect it back. So again, once you reach the year you reach full retirement age, that number is higher. It's around $50,000, but you don't have to withhold one for every $2. You only do one for every $3. My opinion is just wait till your full retirement age. If you think you're going to continue to work, don't take Social Security early because they're going to withhold it. They don't give it back to you in as efficient way as if you did it differently. But yeah, and that might be why you retire for a little bit before you just jump into Social Security. Maybe live on some IRA money or some savings just to make sure you really want to stay retired. Because if you end up saying, "Oh man, I can't do this. I'm too stir crazy by not having a place to go to work every day. I've got to go back to work," and then you've already taken your Social Security. If you make that decision within the first year, you can always give the money back that you collected that first year. But if you retire and take Social Security for more than a year, you're pretty much locked into that benefit ongoing. So again, it's just, make sure that it's going to benefit you. We want to optimize Social Security. We don't want to take it early just because you think it's going to run out, especially if they're just going to withhold it anyway, and they're going to still adjust your future Social Security benefits if they ever have to correct all the mistakes they've made with our Social Security trust fund.
Jeff, the next common mistake that people make just before retirement is carrying debt. And I know that there's good debt and bad debt.
Well, there is. In fact, some of our strategies actually include debt, one of which is the LIRP, the Life Insurance Retirement Plan. We actually love debt. You know why? Because we're actually borrowing against a tax-free death benefit and using our life insurance death benefit while we live for tax-free income that never shows up on our tax returns. It's a strategy that rich people use all the time, is to borrow at a lower rate than they make. And if you can do it in a tax-free basis, even better. The other thing is if you've got credit card debts and a lot of things that, are more than the 5 or 6% that you can make easily on another fixed asset, then I would pay those off because it's arbitrage the wrong way. Unless you have tons of cash flow and zero savings and you can't pay off those debts, then take that extra cash flow and pay down those higher than 5% debts, as you can through the extra cash flow that you make. That way it doesn't become a burden if you have a slow month or, you need more cash flow for inflation and other things. So if you have a mortgage that's only at 2 or 3%, I would say that's good debt. I mean, now when interest rates were like zero, it might have made sense to pay. If you weren't really into taking a lot of risk, it might make sense for you to even pay off a 3% mortgage if you're only making 1% at the bank. But right now, high yield savings and CDs will pay more than that. So my opinion is make more. Worst case scenario is if interest rates on mortgages come down again, in the bank money come down later to lower what your mortgage is, you've already made more on that bank money and you have a chance to take that chunk and pay down that mortgage if you decided to in the future anyway. So, mortgage debt, I'm kind of ambivalent on. I don't think you have to have a paid off house just to feel good about retirement. Again, it really is a balance between cash flow. What I really don't like seeing is, people saying, oh, I want to pay off all my debt because, I heard a guy on the radio who is supposedly a financial guru. He says, you got to pay off all your debt. Well, and so you go do that by taking money out of an IRA. Let's just say you have a $500,000 mortgage and you go, oh, I'll just take it out of my IRA, and you pay $500,000 and pay off your mortgage because you want to be debt free. Guess what? I hope you took $750,000 out of that IRA, which will never grow again because you're going to have to pay $250,000 in taxes or more on that money just to pay off your house. So again, it depends on where the money's coming from that you're paying that debt from. Don't increase your tax burden or go into a higher tax bracket just to pay down a debt that you could pay off over time if it's at a reasonable interest. So, if it's a $20,000 credit card that you're paying 20% interest, yeah, you should do that. In fact, in that case, it might not be a horrible idea to take $20,000 out of an IRA if that's the only money you have, because the taxes, if you're in a reasonable tax bracket, you're not going to get dinged as bad as that interest over the next couple of years. 20% interest, if you're only in a 12% tax bracket, I'd rather pay the taxes, right? So again, it's really a matter of letting the math make that decision for you. Debt could be okay, but it might not be okay. If it's just something that in your mind you have to have it paid off because you can't sleep if it's not paid off, then let your value system and your heart and your gut and your headache be your guide rather than the math. But I'm more of a math guy, so if the numbers make sense, pay it off. If the numbers don't make sense, don't pay it off.
We're talking about costly mistakes that people make at the beginning of retirement with Jeff Hogan of Premier Retirement. We've talked about relocating, downsizing your home, planning to work into your retirement years, also taking Social Security too early, and we will continue this conversation next week. But in the meantime, if you'd like to sit down with Jeff, have a conversation about your individual situation, we're offering a no-cost, no obligation, and no judgment Premier Retirement Roadmap. You can get yours this weekend by calling 520-780-9059. It's 520-780-9059. I know it's the weekend. I know it's a holiday weekend, but go ahead, make that call, leave your name and your number, and Shelley will give you a call back in the next business day or two to set up an appointment so you can have that private conversation with Jeff. And again, no cost for this. Certainly there is no obligation, no judgment. Once again, that telephone number, 520-780-9059, or online at premret.com, premret.com. Jeff, happy Easter. I want to thank you for your time, but most importantly, I thank our listeners for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.
Solid wealth management advice is more important today than ever. If you're unsure about your current risk level, if you haven't heard from your current financial advisor, if you feel your successful retirement is in jeopardy, call Jeff Hogan at Premier Wealth Advisors at 520-600-6363. You deserve a team by your side to help protect what you've saved. Call Jeff Hogan at Premier Wealth Advisors today at 520-600-6363. Securities offered through Premier Wealth Advisors, LLC, an Arizona State Registered Investment Advisor.